Chapter 10, property acquisition and cost recovery. And basically what that means is we have acquired property. So we bought it and we traded for it. It was given to us, but we have property and we have to recover the cost in some way. So if you imagine you went out and you bought a $100,000 piece of machinery, how long is that machinery going to last you? So you check with the manufacturer, you check with past history, and let's just say it's going to last you 10 years. So how many years are you going to earn revenue from this machine? So you said it's got a 10-year life, so 10 years. So it doesn't make sense to write off all of that machine in year one. You're matching your revenue with the expenses. And that's according to generally accepted accounting principles. However, the Internal Revenue Code allows for certain accelerated cost recovery. One of those is called Section 179. One is bonus depreciation. We have modified accelerated cost recovery system. And what these do, this one allows you to write off the whole thing in the first year. And it's a economic incentive for business owners to buy assets and have the tax advantage in the first year. Now, that doesn't change generally accepted accounting principles. So then what happens is if you've got your tax return and you're writing off $100,000, but on your financials you've got $10,000, then you've got a $90,000 difference right there in your taxable income as opposed to your operating income on your financial statements. And that results in what's called a deferred tax asset or deferred tax liability. And when you take Intermediate Accounting 2, you'll learn all about that. But I want you to keep that in mind as we go through this chapter, because if you think back to what you learned in Intermediate and Financial, you'll remember we want these to match the revenue. IRS is different. It's an economic incentive. So remember that as we work through these problems. The one that I'm going to kind of focus on today, we're going to look at calculating depreciation deductions. And so we're going to have some assets that we have purchased. And so we're going to have some furniture. We're going to have some machinery, and we're going to have a used delivery truck. And that's important to know if it's new or used. And so with each one of these, we have a cost. And the cost of the furniture, we're going to go with $150,000. The cost of the machinery, $1,560,000. And the cost of the used delivery truck, $40,000. And then we have to know the date placed in service. This is very important as well. And so the date placed in service for this one was 2/3 of 2018. This was 7/22 of 2018, and this one was 8/17 of 2018. Now, this delivery truck, one thing to note, this is not considered a luxury automobile. Now, what we call luxury automobile is probably not the same thing the IRS does. So make sure you look at the definition of what they call a luxury automobile. During 2018, there were no Section 179 limitations. And so this is 2018. And so in 2019, they added some assets. They bought some computers. They did go ahead and get a luxury auto. We have some assembly equipment and a storage building. And so, again, we have to know the cost. And the cost is anything to get it into place, get it ready to work. Anything to help it start earning revenue for you. So it's not just, the sticker price. It's actually what you had to pay to get it into service. And so we have, again, our date placed in service, which is very important. This will go on your tax return. And then it tells us one thing it noted on the auto, and it's something that you always have to ask, it's 100% business. Not always do you get that answer, but this one happens to be. So it tells us for 2019 we had taxable income of $1,732,500. And that's the information we need to calculate our Section 179 limitations. And so it asks us to do the 2018 depreciation deductions. If I can type, we will do that. And it asks us to include Section 179 but ignore bonus. So we're going to do that. And the best thing to do is create some sort of a chart. So I'm just going to go ahead and use what I have right here and bring this on down. And then I'm going to add a couple of columns. So I'm going to say, okay, do we want to do any Section 179? And then I'm going to have what's called, and you'll see why we're doing it this way. I'm going to have my maker's basis, modified, like I said, modified accelerated cost recovery. And then I'm going to do my current depreciation. And then I'm going to do my total, because my total will include my Section 179 and my modified accelerated cost recovery. And I don't know if it gave us guidelines. Let's see. It said there were no limitations decided. Okay, so what we're going to do on our Section 179 is we're going to take it all off our machinery first. We got $1 million. So we're going to take that there. And that's typically in practice what you do. You go with that highest valued asset. So we're going to take that, which then gives us a modified accelerated cost recovery basis of 560. So once you depreciate it through Section 179, it's not part of the rest of your depreciation. And then the way that we calculate the modified accelerated cost recovery, the calculations are in your book. So the first thing you're going to do is go over to page 10-9 and look at your general recovery period. So for furniture, it's 7 years. For trucks, it's 5 years. And then we're going to go over to page 1041 in Appendix A, and we're going to look at our modified accelerated cost recovery system tables. We're going to see in year 1 for furniture, for a 7-year asset, it's 14.29%. Same for machinery. And then our delivery truck is 5 years, so we're going to take 20% there. Let me mark my pages so I can go back to those in a minute because we're going to need that. And so this one is 150,000 times 0.1429. This one is 560,000 times 0.1429. And this one is 40,000 times 20%. Okay, so that is our depreciation. And so our total depreciation would then be our modified plus our Section 179. And I can just fill this down. And then I have my depreciation for 2018. So I'm not going to go ahead and work through all of this. It's the same thing. When we get to 2019 depreciation, we're basically, we'll still have our 2018 assets, and we'll add our 2019 assets to that. So I can go ahead and copy these down for you. And this is very similar to what you're going to see in a depreciation schedule on a tax return. And so I'm going to go ahead and put some formulas in here. And actually what I need to do is copy this whole thing right here and then delete this. Okay, so this is going to be my 2018. This is going to be my 2019 depreciation schedule, which still includes my 2018 assets because I'm on year 2. So I can delete that. And delete that. We don't do Section 179 again on that asset, but we can do some Section 179 down here. And so for 2019, we have our Section 179 of $1,020,000. And we're going to go ahead like we did before and take it on our highest asset, which changes that basis there. And so again, we're going to use the year 1 from the maker's table here, but up here we'll use year 2. So instead of 14.29 here, we would use 24.49. So it's going to be that times 24.49. And then this times 24.49. I'm getting this from the tables. Why didn't that work? Oh, interesting. No, that's still not right. Times. There we go. Okay. And then this one, year 2 for the 5-year is 32%. So again, just go to year 2. And then for this one, you're back to year 1. Computers are 5 years. And so it would be our basis times 20%. And then our luxury auto. Now, you've got to be careful on those luxury autos. You're going to want to go back and look at the rules on a luxury auto. So you'll want to go back to page 1026 and look at the automobile depreciation limits and see for 2019, for year 1, the recovery limit, the amount cost recovery limit is $10,000. So it doesn't matter what the chart says, you have to go with that limit. So it's $10,000 there. And then our assembly equipment, my calculator out. So that's going to be our 7-year, and then our storage building is actually going to be a different table. So let me go ahead and do this one, and then I've got to get back to my tables. So what we're looking at on the storage building, gotta find it. Is our non-residential real property. So it's on table 4, page 10-44, and we have to look at the month it was placed in service, and that was placed in service in November. Is this right? Am I doing this right? Storage building, 100% business. Hold on, I may have told you wrong there. Let me do my calculations real quick. Okay, here we go, table 5. Non-residential real property mid-month convention straight line. And this is for property placed in service on or after May 13th, 1993. And so we're looking at November, and so it's 0.321%. So it's our cost, our basis, sorry, times 0.321%, so 00321. And let me format this so it's not hard to read. There we go. Okay, and so then we just have, our total depreciation is simply our modified plus our section 179, and then we can carry that down. So that's all there is to it. Again, it's very straightforward. And you just follow your charts, watch your limits, and then if we go over, let's see if I have time for this. If I go over here to a, you can see what I do on my breaks, make pickled peppers. Let's go to the irs.gov website and let's pull up a form 4562 so I can show this to you. And this will be a 2018, and so we're going to use this maximum amount of 1,020 because that's what we're doing this particular form for. And then it says the total cost of section 179 placed in service, and that's actually going to be $1,680,000. And then threshold, and that's given to you $2,550,000. There's no limitation, so there's no reduction in the limitation. And then finally, we have our dollar limit, which is the $1,020. So then it says, what are you going to do your Section 179 on? And we've got the assembly equipment. The cost was $1.2 million. Oh, how did I get up there? Put the full cost there. And then the elected cost is the $1,020,000. And then again, typically your software will do this for you, but I want to show you kind of the way. Oh, I wish this would work a little bit better. All these different totals. Okay, and go back and read all of these, please. We didn't do any bonus depreciation. And so then our maker's deductions for assets placed in service in tax years beginning before. So now remember, we're doing 2019, so pretend that 18 says 19 because the 19 forms aren't out yet. So that's going to be $186,679. And you can look back at the problem we just worked to see where we're getting these numbers. Yeah, that's right. Okay, 186,689. And then it asks us for assets placed in service during 2000. Pretend that's a 19. And so we add these all together. So our 5-year property is $400,000. Recovery is 5 years. We're doing half-year convention. And we're doing double declining balance is what the method is called. And that gives us the depreciation of $80,000. Okay, and then our 7-year property, we're adding those together. I'm having a hard time reading my numbers. Hang on, I've got to go back. $180,000. This is 7-year. A lot of the stuff is duplicate. I completely see that, and believe me, when you put it in the software, fortunately it doesn't, and the depreciation of that was set at $25,722. Again, this is coming from our depreciation schedule that we just worked on. And then finally, we have non-residential real right here, and it asks us for the month placed in service, so we're going to put that in there, and it was $700,000, 39 years, and it fills all that in for us, and so 2,000 because that's the only options you have. And then we have listed property, and that's that luxury automobile, so $10,000 goes there. So we've got it all in there, hopefully, and so that comes up to our total, which is $1,324,648, which is what we calculated on our spreadsheet. And then on page 2 is there, is our listed property. So this is our automobiles, aircraft, property used for entertainment, recreation, and amusement. This one is used more than 50% in business, so we would put our luxury car there. Date placed in service was 5/26/2019, 100% business use. The cost is $80,000, so the basis is $80,000. The recovery is 5 years. We're using half year, and our depreciation deduction is $10,000 because we're limited. And we have no special depreciation. So the other thing you have to do is you want to come down here. Now, we would want to put our mileage information in here, but we want to make sure we check these boxes, answer all the questions about the automobile, and then that should take care of your Form 4562. This goes with the business that this is attached to, and so we would have our taxpayer's name here, what the business is here, and their identifying number, which can be Social Security number or federal ID number. So that's depreciation. You'll learn how to read depreciation schedules on a tax return real quick. It usually has all the information that you need. Sometimes you have to talk to the owner or talk to the previous accountant to get more detailed information, But you always want to see that depreciation schedule when you're looking at a tax return so you can get the details that you need.